The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Whites, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, welcome back to the show. I am your host, Peter Weitz. You're listening to the In Black and Whites radio show. Every time I hear that music, it just makes me think of radio show and it's business time. And so I invite you to the program. Welcome to my version of business time. We're glad you could be with us today. A great show lined up for you. I'm going to welcome back our guest, Kevin Lane, in just a minute. But before I do that, a couple of quick housekeeping ideas. You're going to want to call in today and pick Kevin's brain, particularly once you hear sort of how he picks a stock. But before I do that, real quick thanks to our sponsors, Stephen Douglas and Associates, the law firm Retzel and Andrus, and American Century Investments. We appreciate all you do for us here at the show. To reach us on our blog, and we'll be posting a lot of the things that Kevin talks today on the blog. Kevin's also going to suggest some pretty basic books on stock picking that you can pick up, and we'll put all that on the blog for you to read. You can find us at inblackandwhitez.com, inblackandwhitz.com. You can find us on Twitter. We'll be tweeting some of Kevin's comments today, the @ Peter Weitz, and you can find us on LinkedIn under my name, Peter Weitz. So we got a bunch of emails over the last couple of days in anticipation of the show. I know I got one from as far as in Hong Kong. My friend Mike Rice at Purple Rich International Limited emailed wanting to know what we think about and how we select the stocks, because we oftentimes come up with here at our company at Fusion Analytics stocks that people haven't heard of, but yet they go up or down based upon what we think. And it's all driven by some of the data that we perform, some of the research, and a lot of the mathematical algorithms that we've come up with. And we're going to really talk more on a macro level and on a micro level, how our Chief Investment Officer, Kevin Lane, picks stocks and the things that he thinks about throughout the day. So feel free to dial in 866-472-5790 and ask Kevin any question you may have regarding how he picks stocks, or even ask him his opinion about stocks. You won't be able to trip him up. I'm going to certainly give it a shot later in the show, but I don't think I'll be successful. He really knows what's going on out there. So with that, I want to welcome back to the show Kevin Lane. And Kevin, without me going into phenomenal detail about his resume, I'm just going to sum it up simply as saying BusinessWeek magazine ranked Kevin one of the best stock pickers in America. And it's based upon his success in the past of determining when the markets are going to fall apart, when they're going to grow, and his ability to find the needle in the haystack, to find that company that I was telling you about that you may not have heard of, that all of a sudden just, reaches new levels and new highs in its price. And, he's a noted lecturer on this subject. He's amazing in his algorithmic technical trading strategies, and he's going to get into that heavily today. Kevin, welcome back to the show.
Thanks, Peter. Appreciate you having me.
And I want to start, Kevin, with just talking about let's just say that our average investor is really interested in the stock market, but doesn't necessarily know how to begin. And, there's been some strategies, and, we put it up on the summary sheet today on the webpage regarding how people pick stocks. They throw darts against the wall. They buy companies where they shop. If I'm a big fan of Whole Foods and I walk in the store and it's really crowded, I might just buy stock in Whole Foods because it seems to be making money. But those strategies, while they may work, they seem a little bit missing some of the real fundamentals of really how money is made in the stock market. So just from a macro level, just walk me through, how the average investor can just begin to think about or where they can go to find information to understand how markets move.
Well, it's a great question. A lot of people coming to new industries always, have that question, how do I get started? Where do I get my feet wet? How do I learn? And really one of the best ways, excuse me, and let me preface this by saying there's not really a lot that you can learn in books or academia, if you will, in terms of, going to, when you're in college and taking stock market courses or whatever, because, at the end of the day, what you may learn in a textbook, you'll find out doesn't work in the real world. The only way you can really learn, and you'll hear this over and over from, even the greatest investors out there, is by learning from your mistakes. But really to get started, the best way is to, find some good resources, in terms of, just some literature on the subject, just to, familiarize yourself with it. People always joke about, the dummy series books, but they're actually really good, and, without, insulting anyone, the, stock market investing or how to invest, for dummy series is really a good start, because what it does is it gives you a good base foundation in terms of, trying to get your feet wet with the terminology and all the different things that you'll encounter. But really the best way to do it is to find some good resources, and we'll definitely give people some of those resources on the blog later in terms of books that I've read. You touched upon your idea of investing in what you know. That was made famous by Peter Lynch, the famous Fidelity Magellan fund manager, who said obviously you should invest in what you know, and if you know retail and you know what you like, if you like it as a consumer, obviously then there are probably other consumers that like that product as well, and that's certainly one way to go about it. But as you said, as you delve more into it, there's more ways to slice and dice the process of research and get more sophisticated, if you will.
Yeah, and I went, I was on the internet this morning in anticipation of our conversation, hey, Kevin, just looking at some things, and I saw, there's a website, or I guess it is a website, the American Association of Individual Investors. And I know, Kevin, you use that site a lot because the data they produce is tremendous. But it was interesting. I printed a 6-page essay they put together on the top 10 economic indicators and why they're important to us as an investor. And they're things we hear about all day. And I'm not going to touch on all 10, but I just want to read a couple because they're things we hear about all day. And there's one in particular I want to focus on. But interestingly enough, real gross domestic product, the consumer price index, money supply, consumer confidence, and current employment statistics. I mean, those are just 5 of the 10. And they're interesting because we hear those all day. I want to focus one on consumer confidence and just get your interpretation of what it means and why it's important in investing. And then there's a second chart I want to talk about when we finish with this.
Sure. Well, these are the interesting, debates that people have, meaning that when you talk about consumer confidence, obviously a confident consumer is likely to spend more. And when consumers are confident, the economy is likely to be doing better. And when the economy is likely doing better, it's sort of a trickle theory, and corporate earnings are doing better. However, the interesting dovetail to that, which is people don't understand a lot, and this is what I'm saying, like when you read about these things, you say, well, I got to keep an eye on GDP, or I got to keep an eye on this. When you get right down to it, a lot of times, by the time consumer confidence, is really high, the stock market, remember, is a discounting mechanism. The stock market is not going to wait for things to get better. It's going to anticipate they get better. So a lot of times, and we saw this in the post-2008 financial crisis to present, that when things look their worst, At that point, the market is, and investors are believing things can't get any worse. Therefore, I'm going to buy now. If you had waited for consumer confidence specifically to come back to the levels that would suggest a robust consumer, you'd only be investing now, and the market, of course, is up 178% from its lows. So one of the things that, while I pay attention to them, I tend not to look at economic indicators as much in regards to picking stocks and market timing, only because they tend to have a lag relative to what the market itself is actually doing.
Interesting. And one other interesting statistic that they put out is they put out the sentiment of, and I want you to explain it briefly, of where the market swings relative to how much the average investor has invested in the stock market and how that momentum could potentially sway the direction of the market.
Sure. It's actually, one of the very overlooked data points at AAII, which is the American Association of Individual Investors, as you mentioned earlier. A lot of people look at the bull-bear survey, how many investors are bullish versus bearish, but they do another interesting survey where they look at what is the typical asset allocation mix of the average investor, and they keep it just to three categories: stocks, bonds, cash. And, over the course of 27, 28 years that they've been keeping this data, on average, individual investors are about 60% allocated towards stocks. That would be a normal historical mean average allocation. Now, how far investors deviate away from that mean, meaning how far above 60% or below 60% do they move that equity allocation, can really give you interesting clues. And I'll go back to 2000 first, during the internet bubble. And at that point, stock allocations right at the peak had gotten to about 78% or 18% above the 28-year average. And what that suggested, or what that meant, was at the time, people had gotten so tired of being in bond funds and watching internet stocks race up and hearing their neighbors and their friends and their colleagues say how much money they were making in stocks. Right at the last minute, more and more money started rotating into equities. Of course, it turned out to be the wrong time. It was, okay, everybody has bought everything they wanted to buy. The theory is, who's left to buy if everybody's fully invested? So if everybody's deployed their cash into equity markets, then there's really theoretically nobody left to buy, and of course then things come the other way. Conversely, after the 2008 financial crisis, at the 2009 market lows, individual investors were underinvested by almost about that same 18 or 19%. So their allocation had shifted from 60% being the norm, and right at the worst possible time, after a 50 some odd 60% correction in the S&P from peak to trough, people then all of a sudden decided after that carnage that it was a good time to change your equity exposure. So I tend to look at that indicator more as a contrarian indicator in terms of when too many people are invested in equities, I don't want to be in them. When nobody's invested in equities, I want to be in them. So really, and that's kind of a hard thing. And sliding back to what I was talking about with economic indicators, it makes theoretical and practical sense to say, well, GDP is better and consumer confidence is better and more people are invested in equities. That's a good thing. But you hit those extreme points where, again, the market is looking forward. When we ultimately do have another good-sized correction, while we're correcting, everything's going to look really good at the top. The headline news you read in the Wall Street Journal and Barron's, what you hear on CNBC, everybody's going to be talking about how great things are. In 2007, people will say it differently now, but in 2007, if you go back, and I've done this, I've analyzed old headlines before, near market peaks, things were pretty rosy. The comments coming out of analysts, now retrospectively, everybody remembers it different and says, well, we were warning of the housing bubble and we were warning of stock prices. It's not true. If you look at broad traditional media, right near the peaks, 90% of the stories and the headlines you'd read in the papers were very bullish. So the market, like I said, will always look forward, not at the present. And so, that's a very interesting indicator, and we track it very closely. And to end that little bit of the conversation, that indicator, and investors are now about 9 or 10% above that mean. Now, while
and we're going to talk about, Kev, we're going to talk about what that means, that 9 or 10% mean,
sure.
When we come back from a short break. You're listening to the In Black and White's radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hey, welcome back to the show. I am your host, Peter Weitz. You're listening to the In Black and Whites radio show. And right before the break, we were talking with Kevin Lane about sort of on a macro level where he thinks or where he begins to think the markets may sway. And we were talking about a specific indicator that's put out by the American Association of Individual Investors. And it basically what Kevin was saying is that right now the market is about 10% more invested in equities than the typical 28-year historical norm. So you're seeing a big slant into the equity side. And when you see that, oftentimes that leads to a correction. But Kevin, give me an idea of where we are in that cycle and what you think that means for an investor.
Sure. I think, we were talking about it, off the break, sort of to use a baseball analogy. If this was a baseball game, we could be in the, the 8th or 9th inning. The market has come a very, very long way, from the 2009 lows. And, with that, how do you get the market, to go up? The market, if you want to break it down, and people say this all the time, but if you want to break it down to its, bare elements, it's a byproduct of buyers and sellers, demand and supply. And, to get the market to move, you need more demand, more buying power than selling power. And so obviously to move up over the last 3 years, there's been money flowing back into the equity markets. However, it's been flowing in more aggressively later. And I like to call that, the people that are coming to the party late. So we've 180% off the lows in the S&P, and now all of a sudden, and I don't say this in a negative way, but now all of a sudden, a larger swath of people that have sort of been on the sidelines are deciding to come back into the market, and we're getting that above percentage equity allocation. And so my fear is that when you get to those norms, what it does is it suggests that sort of everybody is all in, everybody's gotten to the party, and then the party usually at some point ends. When I say it ends, that we have to dovetail that because nowadays everybody thinks every correction is going to be like 2008. And 2008 was a multi-generational correction. We haven't had a correction like that in a long time. So when we say the party is over, we don't mean, there's going to be a 40 or 50% correction, but, maybe something along the lines of your normal 20% correction, 17 to 20% correction. But, keep in mind that if you're holding, a portfolio of stocks that are much higher volatility or beta than just, your Fortune 500 S&P companies, that 20% correction in the S&P could be, 30 or 35% in a portfolio of, higher beta stocks.
Interesting. So with that, Kevin, we've got an idea sort of on a macro level. If you go to some of these sites and follow some of the big statistics, you can get an idea of where the market sits. But let's drill down to, now we have a bench line of where the market is. Let's drill down to how we actually go about selecting stocks. And I want to stay away from the throw darts against the wall, or, the sell at the Masters, buy at the World Series kind of strategies, and talk about what you think about. And, we've spelled it out many times. It involves three types of investment disciplines: fundamental analysis, technical analysis, and quantitative analysis. So before we bore all the listeners with the power of all those, I want to just give me an idea of what those three things really mean.
Sure.
So let's start. Yeah. So start with fundamental analysis.
Sure. So, fundamental analysis would be, looking at things like, how much cash does a company earn, cash flow assessment, earnings, how robust are the company earnings. They would look at valuation, what is, the typical benchmark, like a price to earnings ratio, which would be a PE, or price to growth ratio. But basically looking at a lot of operational metrics of the underlying company to determine if the company is potentially undervalued or is growing aggressively. And really, there's a host of those things, and in different sectors you look at different things. So like in banks, price to book, would be more important than in software. It would be, price to sales would be more important metric and things like that. And you can get really granular about the fundamental metrics you can apply at a sector level. But basically fundamental metrics are looking at, company-specific data points to see how well they're operating and executing.
And so it sounds like it's a lot of complicated math and a lot of sophisticated ratios, but is it really that difficult to understand, what the fundamentals of a company are like for an average investor?
I don't think so, anymore. I mean, there's so many resources, and the web obviously is changing everything, we do. And so it's happening that way in investing. So there's so many resources where you can find things and screeners. And again, I know you're going to have a bunch of that stuff up on the site after. And so I think the internet, and I hate using that term, but, this quote-unquote level the playing field for anybody. There's a lot of smart people out there that share content in communities and things of that nature. So I don't think it's as challenging as it was, say, 10, 15 years ago.
Well, the second piece you look at is technical analysis. So explain how that's different from fundamental.
Sure. So technical analysis is looking at things like charts, the momentum of the price, looking at the momentum of the group. Is it one semiconductor stock, making new highs, or is it, 80% of them? And the idea is that, and it's been borne out in, a lot of academic research that, momentum, price momentum is actually a very good future predictor of forward performance. There's a lot of academic studies you can find on the web about it. And let me just quickly, because I have a special spot, in my investing for technical analysis, because that's kind of how I originally cut my teeth. And I'll tell you an interesting story, and I think your listeners will appreciate this. So I started like everybody else, when I first started this business back in 1993. And I would buy a company because I read something in a magazine or somebody told me about a company they heard about, sort of the tip network, if you will. And everything sounded incredible. I'm like, boy, I'm going to make a lot of money. This is a great idea. And I'd buy the stock, and little by little the stock would come down. And at first I wouldn't be worried about it because it was just, a negligible correction, not a large correction at all. And all of a sudden it would come down a little more. Now all of a sudden I'm down 10% within a week or two after buying the stock. And I'm saying, geez, this company has all this great stuff going for it. And, they're opening stores left and right and their products flying off the shelf. Okay, I'm down 10%. Maybe I shouldn't worry about it. And now the stock goes sideways, doesn't do much for a couple of days, and it starts drifting again. Now I'm down 15%. And I find myself scrambling to read other research to make me feel better about why I'm in a stock that's acting like garbage. Then, 2 days later, the company warns that they're going to miss their quarter earnings announcement, and the stock goes down another 10%. And all of a sudden I'm sitting there going, how did this great company I own end up down, 30, 35% in a matter of a month or two? And I'll never forget this day for me. So I was at a Barnes & Noble, and I was reading some books. I went to the finance section figuring, hey, maybe I can read some stuff. And I picked up John Murphy's book, which is considered the Bible of Technical Analysis, and I read the preface in the intro section. And the intro section basically said that, the market is a discounting mechanism, and that chart is a reflection of all known and sort of unknown information, if you will, and that, when a stock is going down, you can be rest assured it's going down for a reason. Maybe somebody else who's smarter, maybe somebody that's even playing with unfair information, inside information, somebody knows something. There's a reason that stock is, going down consistently, or there's a reason the stock is going up consistently. And I really gravitated towards that idea that that chart, that picture you look at when you look at a chart, is a reflection of all aggregate opinions, information, knowledge, et cetera, and can really be a leading indicator. And I have this sort of term that, a good chart usually means a good stock, and a bad chart usually means a bad stock, and then try to marry, the fundamentals and the quantitative to that.
Interesting. And, we're going to talk more about how you intertwine the two and which ones you feel are, how you sway technical and fundamental analysis. I mean, meaning that, how do you marry the two together? I think we'll probably get into that deeper after the break. So I want to take a quick break, Kev. We're going to come back and talk to you more about that, talk to you about some of the other factors that go into stock picking, and that's how to know when to bail. But in the meantime, you're listening to the In Black and White's radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hey, thanks. Welcome back to the show. Peter Weitz in Black and White's radio program to check out and see some of the information that our guest Kevin Lane has been talking about today. Make sure you go to our blog after the show. We're going to post all of this data in blackandwhites.com, or you can follow us on Twitter at Peter Weitz, or you can follow me on LinkedIn at Peter Weitz. So we're back with Kevin Lane. Prior to the break, we were talking about some of the things that he thinks about and how he analyzes a company that ultimately leads him to picking a stock. And we had spoke briefly about fundamental analysis and technical analysis, and I want to touch on the last one, quantitative analysis. And then right after that, we're going to get into what the most important part of stock picking is, and really the crux of where Kevin is successful. So Kevin, just briefly touch on what you mean by quantitative analysis. So we've ripped apart companies and looked at their balance sheets, and then we've kind of evaluated the sector and see how they perform within their peer group. And now we're going to get into quantitative analysis.
Sure. So one of the things I like to do is, and I learned this, the hard way. Like I said, earlier in the show, a lot of your best lessons come from your mistakes, and I think that's true in life, as well as investing. And one of them is not being emotional. Too many people get emotionally attached to a company, and it's hard to detach themselves from it, and that's how they end up sitting with a stock that falls precipitously because they can't unlock themselves from the story and the amount of time they invest in the research to buy it when it goes wrong. And so the quantitative part for me helps keep me unemotional and really rigid in my criteria. And so for me, quantitative analysis is looking at, characteristics of stocks in the past that have done really well. And what did they look like? Were they stocks that, were in the top 10% of all stocks in terms of their earnings growth? Did they have high sales growth? Were they stocks, that were within, their all-time highs? And really look at it, and it's almost like reverse engineering, and that's kind of where the math comes in, is you look at over the last 20 years and say, or 30 years, whatever it is, and say, geez, these stocks that really have crushed it. What were their characteristics at the time they were about to take off? And then you can screen for those kind of criteria, and a lot of times, and, IBD, of course, does this Investors Business Daily, and we do this as well with our Fusion IQ software, and really just looking at, what are the characteristics of winning stocks, and really narrow that universe down, because when it comes down to it, you've got thousands of stocks, and how do you narrow them down? And that's where the quantitative part comes in, is you can screen for these sort of criteria that have developed well. And there's a book called Quantitative Strategies for Achieving Alpha. I know it sounds very crazy and intimidating, but it's a really good book, and it points you, as a gentleman from S&P that did a lot of work on this, and it shows you, the various things you can screen on, like cash flow and this and that, and what ones have really done well. And I would suggest people, look at that book and buy that book maybe to help them with their screening criteria. But quantitative is a way just to look at unbiased, characteristics of winning stocks and or losing stocks to know what to screen for and what to avoid.
And now I want to lead to the most important part of investing, and it's certainly the part that I think the average investor misses out on. And I think, Kevin, when you hear this, it's going to resonate well with you as to what exactly solid investing is all about. And here it is.
You got to know when to hold them and know when to fold them. That's perfect.
And know when to walk away and know when to run.
It's perfect because it's funny. I've talked to and interviewed as well. A lot of great investors, and one of them said to me recently, Ned Davis, who's down in the Vero Beach, Florida area, and Ned is one of the best known institutional investors. And he said to me, he said,
and by the way, going to be a guest on this show in a couple of weeks.
Exactly. And, what Ned said basically was you got to avoid the 2001, 2002 internet bubbles. You got to avoid the 2008. You got to avoid these big corrections. How you make money over the long haul. And I always say, we always joke about this internally. When we talk, any dummy can buy a stock. Knowing when to sell it is really when you make your money. And that sell discipline, people put so much emphasis into the research of getting into a stock, but don't really do much emphasis on how to get out of the stock. And one of the things I always struggled with as well was sometimes I would buy a stock at 10. And it would go to 13 in, a month or whatever. And I'd say, hey, 30%, I'm a genius, woohoo, And then the stock would start to go down a little and I would sell it. And then I wouldn't look at it for like 6 or 9 months. And then I'd look at, colleagues like yourself and others, and I'd say, geez, remember that stock we bought at 10 and we sold at 13? This is now 6 or 9 months later. And I'm like, it's now at 27. And so it's not only about when do you sell when things are going wrong, but it's also how patient are you when things are going right? And so I always struggled with that. And one of the things that we developed internally for ourselves, and we also made it available in Fusion IQ, is this IntelliStop process, which is a ongoing, smart, intelligent stop loss system that changes with a lot of the data points, and really can help you stay in a stock longer. And then obviously, when you violate that stop, while there's no such thing as a holy grail, it's a good indication that, you should probably run. So I'm not saying you have to use that, but I always make it a point when I go into a trade, before I buy the stock, I assess my risk and say, what's my out? When, in the immortal words of Kenny Rogers, when do I fold them? When do I run? And so if I buy a stock, the same day I buy the stock, I know what my exit strategy is in terms of what do I think potentially the upside could be. And more importantly, if it's going against me, where am I willing to pull the ripcord? And I think people really need to think about that when they're buying a stock. How much of my capital am I willing to lose if this stock starts to go against me?
Well, and I hear that a lot, when we talk to our investors, Kevin, we hear, people start a sentence with the words, I think. And it reminds me back of the real estate, the real estate boom, when everyone was getting into real estate saying, oh, this is never going to end. It's going to go up and up and up and up. And, you mentioned in the beginning of the show, we talked about discipline and having discipline in order to be a shrewd investor. And so are you saying that when you look at a stock, you put a target of what you think it's going to go up to, and when it, so let's say, hits that bogey, you're going to get out of the stock regardless if it has more to run or not? I mean, is that a credo that you preach, that you want to be disciplined so that, you take your profits when you can?
Yeah, I think, discipline is the key, and that, again, ties into that emotional part. It's very, very hard for people not to be emotional. I'll give you, for instance, just a couple of weeks ago when the market, went down 6% from the peak before we rallied back towards the peak here. It's very hard when you're looking at your portfolio, and all of a sudden, like a 5-day span, it seems like everything is getting hit and you're losing money, to not want to sell And then, of course, if you do that, you have to come back in at higher prices if the market turns. You never want to be Pavlovian. And for those of you who don't remember that famous Psych 101 study, it was called Pavlov's Dogs, where they did a psychology experiment that, they would give dogs food, and then they would basically then show them food. And because they triggered when they saw the food, they would start to salivate because obviously they were hungry. Then just at the mere sight of a picture of food, they would start to salivate, meaning they were conditioned and programmed. And I think too many people overreact on the upside and the downside. They get too euphoric when things are going well, and they get too, there's too much despair that sets in when they get on the downside. So on the upside, when things are working in my favor, I like to have a rational target. I look at kind of what the analyst estimates are in terms of their target prices. So if I own something at 10 and the analysts are saying it, on average, they think it can go to 30 or what have you, and I'm in the profit. What I have found is your good stocks, the ones that are really doing well, they tend to always run further and higher than you think they can. So try to be patient with the ones that are doing well because they tend to do even better than you expect. But yeah, I like to have an idea of what I should expect from an investment or a trade. And I also like to, like I said, and some people use fixed percentage stop losses. They say, hey, if I buy this at X, and it goes down 10%, I'm going to sell it or what have you. And we used to use a variety of those things until we developed this IntelliStop program. And now that's kind of what we use now because I think it's a better, intuitive, ongoing way to manage risk.
And so, real quickly then, I mean, do you still feel there's a little bit of room left in this market? Just from a stock picker perspective, what's your take at the moment? Well,
like I always say, to people when we do webinars and things about the market, obviously there's greater risk in buying a stock today than there was 6 months ago at lower prices, a year ago at lower prices, 2 years ago at lower prices. But that doesn't mean there's still not upside left. But again, the process is the same. So I'll give you a quick landscape of when I walk in. When I walk in, I kind of have my picture of looking at all my indicators of how comfortable or not I am with the market. Then I run through my screens and I look at the stocks that are, percolating to the top of my screens. Then I assess the ones and say, okay, out of these 10 or 15 stocks, here's the ones where I have the greatest upside, and relative to where I'd stop myself out or where I'd take myself out of the trade if it wasn't working, I have the least amount of risk. So you want to have the least amount of downside risk with the greatest amount of upside return, as a basic rule. And then those are the stocks that you usually try. But, we've been, relatively fully invested for quite a while with some fluctuations in profit taking, and we remain fully invested. We're adding new equity exposure here, but very limited, because a lot of our stocks we've owned for longer times and at lower prices. So I think there's greater risk in adding now, but that just means you need to be more vigilant in your risk management if you're adding new money to the market now.
Interesting. We're going to take a quick break, Kevin. When we come back, I want to talk about sort of the one thing that an investor can do, and I think I know what it is, and I hope that you'll agree with me. And if you don't, that's okay also. But we're going to talk about the one thing that the investors can do to make themselves better stock pickers. We're going to take a quick break, and we'll be back. You're listening to the In Black and White radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Thanks. Welcome back to the program. I'm joined today by Kevin Lane, the Chief Investment Officer at Fusion Analytics and Fusion IQ. What we've spent the vast majority of this show talking about are the things that Kevin thinks about beyond just throwing darts against the wall for stock picking. And I thought it'd be real interesting to end the show with what we're going to call Kevin's Commandments. And I think we're going to do is we're going to outline the 10 simple things that the average investor can do to become a better stock picker, to become better educated about what's going on in the market. And I don't know if this is one of the commandments or not, but I'm going to throw it out there. And I think the whole thing is that I think people don't really do their homework. And, you mentioned it and I mentioned it. You go out and look for a car. You're going to test drive 4 or 5 cars. You're going to make sure it has all the accoutrements and all the bells and whistles that you're looking for. And you're going to kick the tires. You're not just going to go buy the car. And I think with stock picking, people just say their neighbor said, oh, go buy this company, and they go ahead and just buy it. So I don't know if that's one of the commandments or not, but it's kind of my thought.
It definitely is. I mean, I always am an advocate of, someone doing their own homework, and that's important. Now, that doesn't mean you can't get resources and read things, on the internet and source other people's stuff, but doing your own work, your own homework, and I think you hit it on the head. I mean, people spend more time researching on Consumer Reports what washing machine or laptop to buy, and on an expenditure, that's going to be $300 to $500, and do investing, $50,000 into an individual stock, or depending on the size of your portfolio, even more money. It's sort of haphazard and by the seat of their pants. And, it's like being in, I love using analogies because people can really kind of gravitate towards them and draw them. But, it's like football, when the coaches, they plan all week for the upcoming game on a Sunday. That, they look at film, they look at tendencies of the other team, and they really strategize and try to put the most effective game plan together. And like in life and like in investing, sometimes that goes well, sometimes it doesn't. Then what do? They make changes at halftime if their plan isn't working well, and that would be akin to when things aren't working well, using stops, getting out of bad positions, things of that nature. So I think the idea of doing your homework and spending a lot of time preparing, there's a quote, and I forget what it's called, and Peter, you probably would remember it, but if you fail to prepare, you prepare to fail. And I think I don't know who said it, but it may have been Ben Franklin, but it's such a great quote.
Well, I'll tell you what, for the purposes of this show, you said it.
Exactly.
How about that? There you go.
Yeah, but it's true, though, because you really have to prepare to be successful. And then, again, and we'll put the 10 Commandments, if you will, up on the blog after the show, but there's a lot of things that go on after. But the first part, like you said, is do your homework, have an expectation of what this investment, is for, what it could be, what your time horizon is, what are you expecting to get out of that trade, that investment, and then, not being emotional, what's my exit strategy. I can tell you some of my best investments and moves, and I would argue that the risk management portion of your stock picking and your portfolio management is more important than the actual underlying stock picking. And really, just monitoring those holdings really closely and making sure, nothing, really hurts you and draws down your portfolio. And quickly, what we like to do and what I like to do is I like to be concentrated. You always hear this thing about diversification. Diversification works well if you're diversified and the different asset classes you own aren't all correlated to each other, meaning that they're not sort of all moving in the same direction. A lot of times I've seen people own 3 different mutual funds, and I run a simple mathematical correlation, and they think they're diversified because they own 3 different mutual funds. But those funds, their price movement are like 95% correlated to each other. So they really only own one fund. And so, as an investor, I like to place bigger bets on a smaller number of stocks. I don't like 50 stock portfolios or whatever. I say, you should never own more than 15 to 20 stocks and really watch them closely in terms of your risk management.
And, it's interesting. I was going to point out, and again, we're going to post the 10 Commandments up on the blog because we're not going to have time to get to them. But, one of the things I did a seminar recently, Kevin, and one of the things I asked, 2 things I said. The first was I asked everyone in the audience, what do you own in your portfolio and why do you own it? And I can never get an answer because the average investor just doesn't know. The typical answer is because my broker told me. And they told me to buy that. And I think that dovetails in what you're saying about doing your homework. My thought is if you're going to put $50,000 or whatever the number is into some investment, you should at least know what it is, just like you were going to buy your car, your computer, or a barbecue grill.
Of course.
The other interesting quote that I referenced was there's an old saying that says, hope for the best and prepare. Is that how it goes? Hope for the best, prepare for the worst? Yeah. And, it reminded me of I asked a show of hands, how many people had recently gone on a vacation, they took a cruise, they were on an airplane, whatever. Take the airplane. Do you think that the pilot hopes that he doesn't crash the plane but is prepared in case he does? No, he gets on the airplane expecting to have a successful flight. But in the event he does not have a successful flight, he's prepared to deal with that if it were to occur. So we almost need to rearrange the way we think as an investor. And I want you to give me a quick answer on how you feel about that, and then we're going to actually sum up our day.
Yeah, I think that's another great analogy. I mean, obviously, when you invest in a company and you buy it, you're expecting the best. I have a friend that quotes that all the time, so it's kind of apropos that you said that. But you're expecting the best when you buy something. You're not going into it saying, I'm going to buy Apple. It's going to be a terrible stock. It's going to go down 100 points. But it can happen. For years, Apple went up, and then, of course, now in the last year, it's pretty much done nothing but go down or sideways. And so had you bought Apple at the higher prices, expecting it to continue to go up, but not preparing that it could go down and get out of it, you're sitting with, quite a big paper loss at this point. So I think that's a great, and it ties into doing your homework and being prepared and having a real strategy and game plan. And I know you sit down with all your clients and really go over that kind of stuff. You educate them on what they own, why they own it. If they were in the audience and you were their advisor, they would be the 1 or 2 people raising their hands. So
I appreciate that. Thanks. Kevin, I can't thank you enough for being on today's show again. We're going to take the vast majority of Kevin's data and information, post it on the blog throughout the day. You'll really enjoy Kevin's 10 Commandments for buying a stock. It's very simple and easy to understand. We'll have some really interesting charts that follow up on what we spoke about today on the program. But Kevin, again, thank you for being on the show, and I hope we have you out of here again real soon.
Great. Thanks, Peter.
Thanks. Coming up next week, we're going to have an interesting program. We're going to talk about the 401k landscape. There's been some interesting legislation and some litigation that's been going on in the 401k world, and we've gotten a couple requests from some listeners to give our take on that. As you know, we focus specifically in the 401k space, so we're going to have a ERISA attorney on board, and I promise it won't be boring. It's going to be real exciting what we're going to speak about. Appreciate you all listening today. I want to thank our sponsors, Stephen Douglas, Retzel and Andrus, and American Century Investments. Please make sure you check out the blog at inblackandwhites.com for some great information. You can always follow us on Twitter at Peter Whites, or you can join my network on LinkedIn at Peter Whites. Appreciate you being on the show, listening today, Kevin. And for all listeners out there, make it a wonderful week. We will talk to you next week. You're listening to the In Black and Whites radio program. I'm your host, Peter Whites, on Voice America Business.
Thank you again for tuning in to In Black and Whites. Please join your host, Peter Whites, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.